Hello, and welcome to the Geopolitics Explained podcast. Today's episode is going to mark the beginning of a short series where I'm going to explore some of the crises that the United States and China could have to address in the coming years and decades. For today, we're going to start by discussing the concept of fiscal dominance. We'll focus on setting the groundwork, answering what fiscal dominance is, and if it's occurred in the past. So, to begin, let's answer the most important question, which is, what is fiscal dominance? Fiscal dominance occurs when fiscal pressures limit a central bank's ability to control the economy through monetary policy. Now, this statement contains a lot of complicated phrases, so let's break it down. So, fiscal dominance occurs when fiscal pressures limit a central bank's ability. Fiscal pressures typically refers to high government spending or large deficits. When a country possesses a large deficit, this means that the country spends more than it receives, and as a result, the total level of debt in that nation rises. So, to return to the definition once again, fiscal dominance occurs when fiscal pressures, which we've just described, limit a central bank's ability to control the economy through monetary policy. Monetary policy is the policy that a country adopts to accomplish goals such as high employment, stable inflation, and also to navigate economic cycles. The primary tool used to do this is interest rates, which are set by central banks around the world. So, fiscal dominance occurs when high government spending or large deficits can limit a government's ability to control the economy through interest rates. So, with the definitions set, what problems can fiscal dominance lead to? So, in an environment of fiscal dominance, debt determines monetary policy. This often translates to debt determining interest rates. The nation in question, under an environment of fiscal dominance, either spends too much, earns too little, or both. This leads to elevated levels of debt on which a nation has to pay interest. At the same time as debt rising, if a nation is spending too much, then excess spending can lead to inflation. If a nation earns too little, it can grow dependent on borrowing or printing money. This can also lead to inflation. As a result of this, we see inflation rising, which, as we saw over the last few years, central banks raise interest rates to counter rising inflation. This lowers credit availability and reduces demand for spending, which should, over time, lower inflation. But we have to remember, at the same time as rising inflation is occurring, this nation in question also has rising debt. As interest rates rise, a nation will have to pay more interest on its debt that it holds. This widens the fiscal deficit, and a nation spends even more than it earns over time, since the debt is worsening. As a result, this central bank in question finds itself in a tough situation where tackling inflation worsens its debt situation. This can create an unfortunate loop. Within this loop, high debts can lead to rising interest costs, which widens the deficit. In turn, market fear can lead to currency weakness, and demand for debt from abroad falls. As a result of this, central banks are pressured to cut interest rates or to print money, but this is occurring at the same time as inflation persisting. This then leads to higher debt, and the loop starts again. This is the fiscal dominance loop. In an environment where this arises, the country in question has two options. The first option is to raise interest rates in an attempt to lower inflation. In this environment, the nation in question seeks to tackle inflation, but as a result, they pay more interest on their debt. This worsens the deficit. Now, this option continues until inflation comes down or until a nation defaults on its debts. The alternative option is that a country lowers interest rates and lets inflation run hot. This means, with interest rates lower, that a nation will pay less interest on its debt, but this allows inflation to run unchallenged. Central banks could then print money to finance their large deficits, or they could directly purchase government bonds. In this scenario, we see money supply growth contribute to inflation. In the worst case scenario, this leads to currency devaluation or hyperinflation, which can eventually lead to default and a change in the currency system. But it is worth noting that there are some historic examples where letting inflation run has actually worked to lower a nation's debt. We saw the first option used during the aftermath of COVID, and this is typically the option that is used until a country reaches unsustainable levels of debt. Once a nation reaches unsustainable levels of debt, the second option, to lower interest rates and let inflation run, is typically pursued because this erodes the value of the debt. It's also worth noting that fiscal dominance is only relevant for nations that can print money, since this opens up the second option as a possibility. As I stated, in the pandemic years, unprecedented helicopter money, quantitative easing, and rising public debt saw fiscal dominance gain renewed attention. Public debt surged, while central banks financed low rates through government bond purchases via the quantitative easing programs. The biggest threat, stability, in this environment is in a potential collapse in currency confidence, which can trigger an inflationary spiral and a political instability crisis. This is what analyst Bill Blaine calls the virtuous sovereign trinity. If one leg of the stool of political competency, debt sustainability, and currency stability collapses, then the full stool falls and instability in all three areas arises. In an environment of fiscal dominance, all three of these issues are relevant. We'll discuss why over the coming few episodes. But for now, we're going to look at some historical examples to locate the potential causes and indicators of fiscal dominance. To begin, we're going to start with Weimar Germany. After World War I, the Treaty of Versailles led to Germany having to pay incredibly high war reparations. This resulted in exponential money printing of the German mark, and as a result, hyperinflation arrived. At the peak, prices were doubling every 3 to 4 days in Germany. By 1923, the currency was virtually worthless, and a totally new currency system was required. Any savings in Germany were obliterated in value, and this led to political and social unrest. Naturally, during periods of unrest, populist leaders take advantage of the narrative and they rise up, seeking to be the political answer to the woes of a nation. In Germany, this contributed to the rise of the Nazi Party. This was ultimately the second option in fiscal dominance, where a nation allowed inflation to run, but this was one of the bad turnouts that led to default. Secondly, we have an example of a post-World War II United States who actually successfully navigated an environment of fiscal dominance. Debt to GDP reached 119% by 1946 in the United States. In response, the Federal Reserve held long-term rates at 2.5% to keep borrowing costs low. Inflation then surged to 14% due to a demand rebound and price liberalisation. The Federal Reserve bought unlimited treasuries and maintained the 2.5% rate. In the aftermath of this 30% of the real debt burden was inflated away. In 1951, the Fed Treasury Accord restored Federal Reserve independence. By 1974, the debt to GDP in the United States fell to 32%, but this occurred on the back of a post-war demographic and productivity boom. It was also anchored by the gold standard backing every dollar, and the United States had a positive trade balance. Finally, political unity existed, which it certainly doesn't today. As a result of these advantages, the United States successfully navigated an environment of fiscal dominance. Next, we have another nation after World War II in the United Kingdom. Now, Britain emerged from World War II with a debt to GDP of 259% in 1947. The UK kept interest rates between 2 and 3%, while inflation sat above this percentage. The British pound was devalued against the dollar, most notably by 30% in 1949. The aim of this devaluation was to restore the competitiveness of the pound. As a result, this was another failed scenario of fiscal dominance, where the British ultimately had to devalue their currency due to a loss in confidence. Final example that I want to discuss is a nation today who is in an environment of fiscal dominance but hasn't yet made a choice on whether they will pursue option 1 or option 2. Japan's debt to GDP today sits at 260%. This is the highest in the developed world. As a result of this, Japan has kept rates at near zero levels for over 25 years, and it directly purchases government bonds, owning over 50% of its total. This is so Japan can maintain an environment of yield curve control and quantitative easing, where it fixes bond yields at low levels. Japan's balance sheet of yield curve control and quantitative easing is equivalent to 130% of GDP. But this has worked to suppress the yields on government bonds. However, Japan is dependent on monetary support for this to function. In the last few years, we have seen some cracks begin to emerge as inflation has rose in the last few years to between 3 and 4%, and the Bank of Japan was forced to end yield curve control. This crisis is still unfolding, but Japan does have advantages, such as a current account surplus and high domestic savings. But we are seeing confidence in the yen continue to weaken, and demographic decline in Japan poses long-term threats. This is once again another example of fiscal dominance, but we have yet to see a serious crisis emerge where inflation runs away from the Japanese. What's notable is when we look at what each of these cases have in common. When debt dictates monetary policy, we eventually see inflation spike. If not managed properly, we see currency devaluation or default. Some nations, as the United States did, have inflated their debt away successfully, and others, as we see with Japan, are yet to make a choice. But the biggest vulnerability here is that devaluation or default are very possible when nations enter into this cycle of fiscal dominance. With some historical examples covered, the next logical step is to identify vulnerable economies of today and the potential indicators that could signal when fiscal dominance is approaching. It's this that I'll explore in next episode. Since I've recently been exploring the United States and China, you can likely guess which one of the two will be the topic of these discussions on fiscal dominance. There will likely be next episode which will focus on the present, and then one more episode after that will be more forward-looking. If those sound of interest to you, be sure to keep an eye out for these episodes. They will be released on Friday and next Tuesday. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? It really helps out the podcast. I've also currently got an offer over on Substack for 20% off for my premium readership. The link for Substack will be in the description. I've been Dylan, and I'll talk to you next time.